Hey traders, this is Blake Morrow with Trader Summit, and I have Eric from EPB Macro Research with me at the end of the year after this chaotic year and central bank activity this last week. How are you doing? Good to see you.
It has been a historic year. Doing well, Blake.
Yeah, it has been crazy. And you know what? I want to start off and just commend you about you've been talking a lot about the housing market, especially the last 6 months or so, and you talked about the markets crashing. Now, crashing to you was not necessarily prices crashing, but transactionally that crashed. And by golly, the markets have come to a screeching halt. You could quantify that as a crash, but prices are still very sticky. So, what are your thoughts here on the housing market? Let's just start off with that.
Yeah, sure. So, whenever I talk about the housing market, I always differentiate the volume cycle and the price cycle, right? Because those are two totally different things. And very similarly to how growth leads inflation, or conversely, inflation is a lagging indicator. When you think about the housing market, volume is growth and prices is inflation, home price inflation. So it's very normal that you see a crash in volumes before you see a big decline in home prices. So we have, in fact, seen volumes crash, 40% decline peak to trough in existing home sale volume, 35-40% in new home sale volume. So 40% decline basically in the volume of transactions nationally is definitely a crash.
Yeah.
But home prices are down on an average basis somewhere like 2 to 5%, right? Some markets like Florida are barely down at all. Some other markets, like specifically in California, are down 10% already, 12% already. But nationally, like you mentioned, very minimal decline so far.
Yeah.
And there's a couple of reasons for that. One is just the fact that there's a lag between the volume and the price. And second is we have this really bifurcated supply situation. So when you look at the new home market or the new construction, you think about a home builder, they build a home and then they have to sell it to somebody. They don't have an existing mortgage. They just want to sell the home. And home prices in the new home market are starting to come down much faster. We're seeing about 8 to 10% declines on average in the new home market because builders are starting to get a lot of inventory. They've been building a lot of homes, but rates have gone up, so nobody really wants to buy them. So you see a big supply increase for home builders, and you're starting to see concessions, price cuts, mortgage buy downs, all kinds of things like that. But on the existing home side, existing meaning someone already lives in the house, most people took advantage of the crazy interest rates that we had in 2021 and 2022 and refinanced their mortgage under 3%. We were talking in the pre-call that you did that yourself.
Yeah.
And once you have a rate that's 2.5 or 3, and the prevailing rate is 6.5, you really don't want to sell that house because that means you're going to have to get a significantly higher mortgage rate. It just doesn't really make a lot of sense. You're certainly in no rush to sell the house. So a lot of people in the existing home market are sort of keeping this supply offline. They don't want to sell their homes because it means they'll have to trade up for a much less favorable mortgage. So the existing home market has a really, really tight supply situation. Just nobody's coming to market, while the new home market is starting to see that supply go up. So there's a little bit of a lagged effect for prices, which is why they haven't come down. And then we also have this dynamic of sellers who have 2% mortgages. They don't want to sell it, and they're not yet forced to sell it.
Well, Eric, it's interesting. It's like it almost feels like a Mexican standoff, right? And you got all these
Exactly.
cowboys with guns, and they're all
Yeah,
pointing at each
it's a good
other.
analogy.
Yeah,
Yeah.
waiting for somebody who's going to pull the trigger first. But if transactions lead prices, what would cause prices to come down? And let me also ask, what would be the cause, and will there even be a price reaction because transactions have crashed, if you will?
Right. So what ultimately is going to happen is eventually, if the economic deceleration continues, which is very much my forecast, which maybe we can get into a little bit more.
Sure.
Eventually job losses are going to come. This is a natural side effect of the Fed raising interest rates, slowing the economy down. Eventually, that slowdown manifests in job losses. Now, nobody who has a 2.5% mortgage is going to sell their home unless they're forced to. And the ultimate forced sale is if you lose your job. So your analogy is very is spot on, where buyers are, below the market. Sellers are still trying to sell their home at yesterday's price. And there's this huge gap, but nobody's really willing to pull the trigger. Sellers aren't willing to hit the bid of the buyers, and buyers certainly don't want to step up and buy homes at yesterday's price with rates that are double or triple what they were. So in my view, and what's obviously an unfortunate situation, is if the economy continues to decelerate, which I very much expect, we're likely to go into recession sometime in the first quarter, in my opinion. With a recession comes job losses, and then if you have job losses, that's likely to cause people who don't want to sell have to sell, and then they're going to basically have to hit the bid that's significantly lower than where the mark is. And once that starts to happen, sort of en masse, then the price kind of gaps a little bit. And I think that's where we're headed.
That makes sense. Well, that kind of takes us into, looking ahead into 2023. It's nice that we're actually catching up at the very end of 2022. And I'm already kind of getting a sense of what you're thinking for next year. But, keeping in light of this conversation that we're having about housing and, possible recession and, and job loss, at what point, and this is a real key component of all of this, at what point do you see the Fed pivoting, or do you see them actually pivoting, and do you see them actually lowering rates into 2023? What are your thoughts with the Fed and maybe where they're heading to with policy next year?
Yeah, I know that the term pivot is like, several years from now, we're never going to want to say the word pivot again. It's like, it's been so debated. I think there's two steps here, right? There's first a pause, and then there's a pivot. Pause meaning at first they're going to stop hiking, and then they're going to cut, right? So there's kind of two phases to this quote unquote pivot. There's a pause, and then there's a pivot. And I think it's an important nuance, because everyone just kind of jumps to pivot, like the Fed's going to raise 75, then cut 75 like a month later. There's a little bit of a progression here. So the way I see this playing out is that the economy is going to continue to decelerate, and we're very close, in my opinion, to the onset of a recession. In fact, I think there's a reasonable probability that, maybe a year or so in the future, whenever the NBER gets around to dating this, there's a reasonable chance, depending how things play out, that the recession could be backdated to start here in Q4. We've seen in November's economic data, we saw contraction in retail sales, we saw contraction in industrial production, and we saw a contraction in employment as measured by the household survey. We also, that's a pretty broad basket of critical indicators that all declined in November. Now, we have to obviously have several more of those, but it's a potential start date. So once the economic indicators contract for several more months, and one of those has to be the widely watched non-farm payrolls numbers, not just the household. But I think in the first quarter, you're going to see that weakness proliferate throughout all sectors of the economy and lead the Fed to stop hiking interest rates. And I think that's a first quarter story. I think there's a reasonable probability that the Fed hikes 25 basis points on their February 1st meeting. I wouldn't be surprised if the economy deteriorates enough where they don't. But I would say that there's a reasonably good shot that they hike 25 basis points in February. And I believe that that's probably going to be the last hike. I think they may have seen the last hike, but they're probably going to hike again in February, assuming that the economy doesn't slow down much more before then. But I think that's going to be the last hike. Now, there's going to be a delay between then, February, and when the first rate cut is. On average, there's about 6 months, which would put you well into the summer, call it something like July or August. But it really depends how sharply the economy deteriorates from then. It's difficult to make, to jump 2 steps ahead. So just talking about step one, I think first quarter story is where we eventually get that pause in monetary tightening, where the Fed says, we've gotten rates high enough, we're well into restrictive territory, we see the effects taking place, we're now going to stop.
The last question I really have for you, because this all ties into everything that you're discussing, is, in my career in the markets, which has been over 25 years, I've been accompanied by a Fed that has been accompanying, did I say that correctly? With monetary policy in a recessionary type of period. But also we're living in a world where I never even experienced inflation at these levels. So I guess the question is to you, and this is kind of the big debate going into 2023, do you think that the Fed is capable of actually cutting rates if inflationary pressures are staying high? And then second question to you, I guess, would be, how do you feel about inflation into 2023? Because that's debatable.
So I would say no, to the extent that inflation is massively above their target, like 6, 7, 8%. I don't think that they would cut interest rates.
Okay.
However, we've had very significant evidence that inflation is decelerating sharply. Now, it's still above their target for sure. But in my analysis, by the time we get to the end of the first quarter, the Fed will have sufficient evidence to say that the momentum in inflation is declining fast enough where, again, we can pause. It won't necessarily be below 2% on a year-over-year basis, but they will have very clear evidence that the momentum is heading downward. And if they hold rates, let's be honest, Blake, at 5%, that is pretty darn restrictive still. So if the momentum is heading down and they're holding rates at 4.5 or 5%, a couple more months later, by the summer of 23, I think inflation will be back below their target. So I think that there's significant evidence that inflation, or the inflationary process, is reversing and actually going in the downward direction. And I think by the first quarter, they'll have more than enough evidence to hit the pause button. And then by the summer of 23, I think that they're going to start going in the downward direction in terms of cuts.
That is, that's welcome. I think that's welcome news to a lot of investors. I think a lot of people, just consumers in general, are probably excited to hear what you just had to say. Eric, I'm always enlightened every time I speak with you, and I know it's been way too long. I'd love to catch up with you in the beginning of 2023 and get your views. As they're fresh, as we're approaching the first Fed meeting of 2023. But I want to say thanks for spending time with the Traders Summit community. What's the best way for us to follow your work? Because your YouTube channel is just a wonderful source for myself and other traders out there.
Yeah, thank you so much. And it's been a pleasure talking to you all throughout 2022. So we'll definitely keep this going in 23. In between our conversations, the best place to find me, like you said, on YouTube, you can search EPB Research. We do a lot of videos. We've been doing the housing market a lot recently because that's been a popular topic. But then on Twitter is another good place. My handle is at EPB Research. I'm pretty active there. And then my website is epbresearch.com. So those are the three best places.
Eric, thank you so much, generously for spending your time with us. I want to wish you a Merry Christmas, Happy Holidays, and Happy New Year to you and your family. And we look forward to catching up with you at the beginning of this next year.
Same to you, Blake. Thanks so much.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.